And Shailesh, a very good morning to you as well, and of course a repeat of our Diwali wishes to all of you from the team here at Profit. Rohit, how's the market looking? How's the Nifty looking?
Thanks and happy Diwali to you too. I think it's very important to highlight here that what is happening is not just short term but medium term, or rather even longer term, because after the bubble that we saw in 2008 burst. It's been on the mind of a lot of people, that you could never get another bubble again. But if you just look at the way the markets behaved, the fact that we are above 18,500 and staying above it for so long simply means that you're at the beginning of something much bigger that will develop into bubbles across emerging markets and commodities. And since you're at the beginning means we have quite some time to go before we are done with it. So you really need to see the big picture, but then again coming down to what interests everyone, the short term. The typical Diwali cycle is that if markets tend to consolidate through October and not really fall very steeply, then typically post-Diwali markets rally into January. So as far as short to medium term is concerned, I think the next 2 months should see a lot of bullish activity into Jan. Typically markets will rally post-Diwali and the bottom gets made plus or minus a few days prior to Diwali. So I think we've seen the lows at around 59.50 odd, and from that low the rally we see should go at least in the next couple of months to maybe 65-6800 in terms of targets forward.
Rohit, you said something very interesting which I want to try and understand how you validate that thought. You said we're at the start of something much bigger. Where do you get the conviction that we're at the start and not already some way through?
Right, standing at 21,000, there are two ways to look at it. You can say double top, you're at the same level, it should probably top out and be over with. But the real measure of whether you're extending into another bull phase or not is really inflation and deflation. And you need to measure inflation in terms of what is happening with money. Are you expanding the amount of money or not? And that will typically show up in two things. One is commodity prices, other is currency prices. So actually you go and look at emerging market currencies, or you look at specific ones like the Australian dollar, the euro dollar or the dollar index. They're actually about to break very key levels. The Australian dollar already had yesterday. The dollar index will, once it goes below maybe 77, 76, it will indicate that you're expanding money supply somewhere in the world. And in a globalized environment, you can't just focus on RBI, because money supply does not have to only increase locally. It can increase anywhere in the world, and then it just flows from there. So just looking at yesterday's Fed action, you can see that the action is towards increasing liquidity and keeping it there. The rest is just up to other central bankers to manage. So essentially, as long as you get expansion in money, or it would have been an accumulation. The fact that we are above it means it was an accumulation or a consolidation period in which the market has now decided to move higher, which means that you're really expanding into a new bubble rather than just ending in a double top. And that's a significant thought, because it means that you can go to completely new levels not seen before in most asset prices.
All right. Shailesh, you want to come in with a quick thought?
Yeah, we have been consolidating for quite some time between the range, 6,000 to 6,250. What we feel is that we are
definitely that's an obvious beneficiary of what has happened, and especially if you look at metal prices. So you can see it clearly in base metals, lead, zinc, nickel, all of them are showing clearly a bullish pattern. So definitely it means that metal stocks would benefit at least from metal prices, apart from whatever potential demand that comes in. So yes, metal stocks should start doing well. Some of them like Sterlite, which has actually consolidated for very long and not done much, should probably start joining the move up again. But I think other sectors which have been consolidating should also be looked at rather than just look at metals. I think capital goods was one key. It actually broke out of a consolidation pattern and started moving up in the last couple of weeks. So capital goods sector should now join the up move. And another one being oil and gas, which was a laggard also for almost 7-8 months, has started doing the same. So these two sectors might be new ones that would actually join the rally, apart from banking that is already on the run.
All right, okay, fair enough. Just hang in there. I got about 30 odd seconds for the pre-market session, pre-open session.